This week on Wealth Track, in an exclusive interview, Wall Street's longtime #1 investment strategist, Francois Trahan, explains why he has turned from market bull to bear. His controversial call and strategy are next on Consuelo Mac Wealth Track. Now, up until recently, Trahan was correctly bullish on the U.S. stock market, as he had been for well over a year. Well, no more. He is adamantly telling clients that this rally should be sold. I asked him why.
Every bear market starts from the peak of a bull market. This business is about looking at what's in front of you. What concerns us about 2017 is that when we look at the state of policy now, what we see is a tightening of conditions. So the same indicators that told you the data was going to get better at the beginning of the year are now telling you that as we get into 2017, the data is going to start to slowly slip.
So which conditions are tightening? Because you've got a new president coming in, who's going to have his foot on the fiscal stimulus accelerator. Isn't that a positive?
Well, sure, but none of that money will hit the economy in 2017, and the stock market can't discount that far. At the end of the day, we're all speculating as to what will happen policy-wise.
Right.
But the hype is incredible.
You mentioned tightening. Mm-hmm. What is tightening? Where are you seeing
at this point, issues? Everywhere. So every gauge of policy that we look at shows a tightening of conditions, whether it's money supply that had accelerated leading up to the beginning of the year has now slowed across the developed world. This is not just a U.S. story. We look at gauges of bank liquidity, like swap spreads, for instance, which had narrowed in the latter part of 2015, usually a great sign for the economy. It's a sign that liquidity is building, that it's about to be deployed, a sign that the data is about to have a bit of a go at it, if you will. Well, they have now begun to widen. We've had big changes in interest rates, of course, of late. And so every gauge of policy that we looked at the beginning of the year was telling us that consensus was looking at the wrong thing. And I would say it's the case again today. I'm not bearish because I think there's going to be a financial crisis somewhere in the world. I'm bearish because policy tells us the economy is going to slow. And that means lower earnings estimates. And unfortunately, right now, it also spells lower market multiples. PEs right now are behaving in a very unusual manner. And what I mean by that is that they're very, very cyclical. And that's not the typical state of affairs with market multiples.
And how are they cyclical? How are the PE multiples, price earnings multiples?
So, historically, when you look at the S&P's PE, it tends to look like the inverse of inflation. So inflation goes up, P's come down, inflation goes down, P's go up. That's why there's a lot of slowdowns historically. So, the exact same picture I'm painting for next year, where the stock market goes up, not down, because slower growth hurts earnings, but it brings about lower inflation, and it helps P's go up. So in a different context, you could say there's a silver lining to my story, which is that slower growth will lead to lower inflation, will help multiples go up. Unfortunately, PEs are not behaving like that. So right now, if you look at the S&P's forward multiple, what you're going to see is that it looks a lot like a leading indicator of the economy. And so if you take the Conference Board's official LEI, or official leading economic indicator index, and you look at the components, so it's things like building permits, initial jobless claims, BAA credit spreads. If you plot those with the S&P's PE, you're going to see that they look exactly the same. So that means slower growth, lower earnings, lower PEs. So you don't have to think there's a recession coming to be concerned about stocks. When PEs are behaving this way, it means that any slowdown is going to give you a disproportional decline in the index. That's why I'm bearish.